Good afternoon, Professor Teo and fellow classmates. Today we will be introducing to you our new portfolio investment model. In today's stock market, there are many different objectives set by different investors, with the two most popular strategies being low risk while bearing low reward and high risk while bearing high reward. However, the stock market is not simply limited to these two aims. There exist situations with fixed budget and expected returns, where the objective is to minimize risk. Since this issue is not well addressed, we have developed a model for this specific scenario. The aim of our model is to minimize the risk for investors. With regards to the data that we will be using, we have decided to include 10 major technology companies: Facebook, Apple, Google, Microsoft, Amazon, IBM, Nvidia, Tesla, SAP and Adobe. We have decided to focus on the technology market due to the fact that it is expected to grow more than other industries in the near future. In addition, millennials, the next generation of investors, are increasingly investing in technological stocks. Lastly, the technology sector is more volatile than other sectors, and therefore is in greater need of a tool to aid prospective investors. Within the technology sector itself, we have chosen well-performing major companies due to their relative stability as compared to smaller, less well-known companies, which is exceptionally important in an industry that is extremely volatile. Thus, they will tend to have lower fluctuations in terms of risk and return, which is congruent with our aim of minimizing risk for our investors. All the chosen 10 companies are major players in the technology sector, with stocks that have lower fluctuations in risk and return, which makes them ideal stocks to test our model on. The reason for choosing this specific scenario to explore is because it is a relatively unexplored scenario of optimization that requires a new model. Having an expected return is one of the goals of the optimization, while minimizing risks is a new scenario that requires a new model. Our model will determine if the expected return is attainable and prescribe the amount to invest in each of the potential stocks. In the case where it is unattainable, the investors can vary their budget and/or expected return and run it with our model again to check its feasibility again. Otherwise, the investors can also consider changing to other stocks and use our model to check for feasibility again. We will be adopting a quadratic programming model, where the objective of the model will be to minimize risk of investment given fixed budget and expected returns. These are two sets of variables. The first one is P, which is a binary variable, meaning whether we will choose to invest in this particular stock I or not. The second one is X, which indicates the specific amount that we will invest in stock I. There are 3 constraints in this model. The first constraint is the sum of X, which is the total invested amount, cannot exceed the investment budget. Secondly, if P equals 0, meaning not investing in a stock, X for this stock will also be equal to 0. If P equal to 1, X can be any amount less than or equal to investment budget, which can be done by adding constraint X less than or equal to P times investment budget for each stock. The third constraint is that the total return reduced by trading costs still need to larger than or equal to the expected return. The total investment budget is $100,000 and the expected return in the next 1-year investment is $300. If the return expectation given by clients is too high to achieve, this model will indicate the solution is infeasible and suggest that they should adjust their expectation or invest in alternative sets of stocks portfolio. The aim of this model is to obtain the feasible expected return with the smallest risk. We set the transaction cost to be $4.95 per stock trade, which is based on the real-world transaction cost charged by AliInvest. The 2 set of variables and 3 constraints are shown in the code. After solving the problem, the model will print out the specific investment amount in each stock to facilitate decision-making. These results tell us that given $100,000, we should invest $41,468.88 in Amazon and $58,531.13 in Nvidia in order to achieve an expected return of at least $300 with the lowest possible risk. Then, the model that introduced in class, which taking both risk and return into consideration will be utilized to optimize our portfolio and compared with the previous model. Different from the previous model, X here is investment fraction in each stock, and the sum of X can only be 1. The expected return constraint will be eliminated, but the expected return will become a component of objective value. With the introduction of transaction cost, the objective will adjusted by adding a new term equals to total trading cost, because this model aims to minimize risk, the second term, and transaction cost, the third term, which both have positive sign before them, and maximize return, the first term, with a negative sign before it. The output of this model the investment fraction in each stock, with a total sum of 1. When lambda equals 0, the risk will be ignored by the model, the only purpose is to maximize the return. The largest return we can get is 353.066, which is larger than return of the previous model $300, because at this time, the model will only choose one stock NVIDIA that performed the best and invest in it. However, this strategy will increase the risk of investment greatly. When setting lambda equals 0.0001, the return will drop from $353.066 to $255.32. At this time, the trade-off between high return and low risk takes into action. The portfolio will be more diversified to minimize the risk, which is 50% of budget for Amazon, 12% for NVIDIA and 38% for Adobe. From the three plots above, we can identify that with the increase of lambda, the risk term will have greater significance. In order to minimize risk, the portfolio need to be more and more diversified, and the return will drop accordingly. This slide shows the trade-off curve graph of this investment model. The red point is the solution for lambda equals 0. Which is investing in only one stock that having the best return performance, resulting the highest risk. After that, increase lambda gradually, the investment risk will be addressed in yellow points. The portfolio solution for lambda equals 0.0001 will have lower return and risk than the red point. Compared with yellow and red points, the blue points, lambda equals 0.001 will have even lower return and risk. For each point on the curve, we cannot improve return without increasing risk, and we also cannot reduce risk without decreasing return of portfolio. The black point which indicate the risk and return of the output of our previous model with the fixed expected return of $300. This point is extremely close to efficient frontier, meaning our model indeed effectively minimize the investment risk and meet the requirement of expected return. After that, we will move on to the analysis of our model. Our model's strengths are that it prescribes an optimum portfolio of stocks that meets the requirement and constraints of the investors. It also allows the investor to view and considers risk when prescribing the stocks, allowing the investors to make informed decisions. Our model can also be modified to accommodate investors who are looking for shorter-term profits, and we can do so by varying the amount of data that we use to the amount that the investors want. For example, 1 year of data to 1 month of data if the investors only want to consider 1 month. Our model's weaknesses are that only past trends are considered in our algorithm, which means that other factors like government regulations and economic events which can affect the prices of the stocks are not considered. Our model also does not support buying and selling actions in the middle of the year since our model is prescribing the stocks for a period of 1 year. In conclusion, our devised model is a simple, efficient and user-friendly model that adequately solves the problem of choosing a portfolio of stocks to invest in to minimize the amount of inherent risk, given the constraints of investor capital, desired expected returns and transaction cost incurred for each trade. While our model is effective, the investor still has to determine which stocks they are considering investing in, which they have to input as the model's dataset before the model can calculate the most efficient portfolio for them. Thus the investor still has to do their own research and planning for the market beforehand. For further future development, we would aim to ameliorate the weakness of our model being locked in into one-time decision for the whole year. by introducing more variables and constraints to make the model more sophisticated. And with that, we have come to the end of our presentation. Thank you for your kind attention.